Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are looking at two oil companies. As you know, I do not have any oil companies in this portfolio, so I have been doing a bit of research. I want to share that with you guys today. Before we do that, I would like you to click that like button, subscribe to the channel, let me know if you have any questions. Join us on the Patreon account, okay, where you can actually get access to a lot of the buys and sells that we make, the dividend calendars, the stock watch list, the ETF trackers, and of course a private Discord where you can actually talk to individuals who are very much like-minded, and who of course share absolutely amazing resources every single day. Now what I want to talk about today is two different companies in the oil sector, but before we do that, let's just regroup and think about the entire, basically look at the bigger picture. Okay, we've got the S&P 500 and we've got the energy sector in the S&P 500. Now as you can see, the S&P 500 hasn't, basically ETF has done absolutely nothing this year. It's almost flat into 2023. Now that attracted me to look at, say, okay, maybe there might be an opportunity to actually buy oil companies. But don't forget, when we look at the longer period of time, so this time last year, they were the best performing sector. So they were up almost to 50%, okay, for the last 5 years. But for the 1 year to date right now, it's only up about 1%, whereas the S&P 500 is now almost up 25% for this year, which is absolutely huge. Remember the beginning of the year where everyone was talking about the S&P 500, it's not going to do well, the stocks are not going to do this and that. And this is why I just always say to you guys, just focus on the long-term plan and don't really focus on the day-to-day changes or prices and fluctuation of prices and so on. Because this kind of thing can easily happen. And if you look at the last whatever year, so since 2008, this is what these sectors have done. So as you can see here, they all color coded. But if we just focus on the energy one, okay, so energy is this one. So today as we speak, okay, let's talk about this first. A year to date, the best performing sector is communication services, okay, or this one here, okay. Communication services includes companies like Google, companies like Meta, and it's probably a lot to do with Meta, the fact that this is up almost 40%, because Meta itself is up almost, I don't know, 200 or 300. Okay, then you've got information technology, or basically tech, that's almost up 35%. Then you've got consumer discretionary, that's up 26%. Okay, then you've got the actual the S&P index itself. Then you've got energy, which is only up about 6%, okay, for the overall. And then industrials about 4.5%. So again, there might be an opportunity there. We've got materials about 2.6. Materials don't really do much every year anyway. There's not a lot of high growth and basically stocks in there. Normally the leading ones are consumer, normally are technology, communications, as well as healthcare, because that's where a lot of the growth comes from in terms of innovations and so on, right? Financials not done well at all. Healthcare has done absolutely nothing. Consumer staples have done absolutely nothing this year. Real estate was actually down a lot, but utilities is basically down almost 14%. So now, given this, kind of gives me the bigger picture. So energy has not done really badly, but there are other sectors that might have an opportunity. But there are two companies that I'm interested, that I want to see a bit more information on. And the first one we're going to look at today is Exxon Mobil. This is probably one of the biggest ones in the oil companies. 408 billion market cap. It has a dividend yield of 3.72, and that dividend is actually well covered, about 80% safe. Okay. Now, when we look at the payout ratio, is only 35%, and they have basically paid this dividend 141 years without reducing that. So it's not increasing every single year, okay, but they have been paying dividends over 140 years. Now, they've increased recently about 4.4%, and the 5-year basically growth rate is up about 3%. The 20 years is about 7%, so not bad. So this is a bit slow, but I think they will continue doing that in the next few years. So as you can see, from 2011 it's actually gone up quite a bit. Okay, before that it was kind of growing, but it wasn't actually hugely growing, and they have increased this dividend for 40 years. So they have been paying it for 141 years, but 40 years they have been increasing every single year, which is absolutely amazing if you think about it. So you get quarterly, you get $3.80 for every share of this company that you own. They've already gone dividend. Ex-dividend was basically November the 14th, and you'll get paid if you own this shares. You will get paid on the 11th of December. I think you've already got paid. So as you can see, here are basically the tracks. So from basically March, so they pay March, June, September, and December, and this is what they paid for in 2021, 2022, and 2023, 2024, and so on. They will carry on. Now, one of the things that you sometimes look at, okay, is the 5-year average, and this says is now might be a little bit overvalued, because what they do is basically what they look at is the 5-year average. So the 5-year average for this company was 4.76, but current dividend yield is 3.72. So if the current is lower than the 5 years, then that means the stock is overvalued, okay, based on this formula. If the 5-year is basically higher, of course, then it means it's basically overvalued. So in that situation, it feels a little bit overvalued. And same goes for the average, the PE as well. So the average PE is a 12.5, but right now it's 11.5. So it's about kind of fairly valued based on that. So as you can see, so energy sector is about 11.9 right now, 11.7. So it's basically tracking the overall market, if you like. Now, a couple of more things that we're going to look at today. Sales has been all over the place, and this is why these companies are very, very cyclical, oil sector, okay? And as you can see here, basically sales has been up and down in the last few years. But when we look at the actual numbers, okay, so this is just the percentage side of things. As you can see here, in 2013 they were making $390 billion per year. Then it kind of declined. Of course, in 2020 they of course didn't make it much, and then it kind of bounced back to 402 last year, where oil prices went crazy, and it has come down. Basically, the next 12 months they're expecting it to come down. Of course, it would have to come back down, because at some point it was over $100 per barrel. So of course it has come down quite a bit. And as you can see here, shares outstanding, they have been buying back their own shares, and this company is now in the process of actually acquiring another company called Pioneer Resources, I think. So it will be interesting to see whether they use cash or basically dilute the shares. Will be interesting to see. I haven't researched on that yet. Return on equity and things like that is about 21%, which is quite nice. Return on invested capital about 19%, and a couple of more things: operating margins 15%, and free cash flow margin of 11%, and then net debt to EBITDA of basically right now 0.15. Normally what we're looking for is basically below 1.5 is basically what's preferred. So that means the company has absolutely nothing to worry about in terms of paying off their debt and so on. Right, so let's have a look in Seeking Alpha. So as you can see, year to date is actually down about 4%. And when we look at, for example, the earnings side of things, this is probably one of the reasons it's not attractive right now. So 2023, of course, is down. 2024 is actually kind of flat. 2025 is minus 2.5, and then so on. So this is a very cyclical business. A year ago, this was different. Right now, of course, it's a kind of flat. But one thing, once they actually buy that company, that will, I think it will change the game for this basically for this company. But right now, of course, it is not that great when looking at these numbers. Now, if we look at basically the ratings, okay, so as you can see here, Seeking Alpha analyst is saying is a buy, Wall Street is a buy, Quant is actually a hold. So what is their price target for the buy? The buy is basically $125, and that's about 23 upside from where we are right now. Right, according to Yahoo Finance analyst, or the analysts that they've actually surveyed, as you can see here, next 5 years they're expecting their earnings to grow about 45%. Now this has something to do with that company they're buying. It can't just be based on organic growth. Okay, definitely not. So 1 year is almost a flat, which is 1%, and then basically the 5 years, right? And then when we look at the Morningstar is about, it's got 4 stars right now. It's about 17% discounted right now. They're basically price target basically for this company is $123 right now. It's $102 right now. So let's have a look at the second company, and that company is Chevron. Chevron has a market cap of 287 billion, so it's slightly smaller than Exxon. Right now it has 3.96 dividend yield, and if we look at the payout ratio, actually, in fact, the dividends actually save 90% right now. And when we look at the payout ratio, about 43, and 111 years of being basically paying that dividend. If you 6.3 in terms of latest increase. The last 5 years, basically they've given us about 6% return and on our money, and increasing basically 6%, and the last 20 years is about 7%. So it's kind of average in terms of basically that dividend. As you can see, they've also from 2011 they have actually been increasing quite a bit, which is really nice to see. And 35 years of increasing that dividend every single year, and 111 years of basically paying that dividend, which is absolutely amazing. For every basically stock that you own, you get basically about $6, just over $6 there. And November 16 was the ex-dividend. In fact, they pay on the same day, which is interesting. So March, June, September, December, that's when they pay as well. So they kind of more or less track each other. Now this one looks like reasonably valued, because if you think about 4% basically dividend yield in the last 5 years, and right now is almost 4%. So it looks like it's basically fairly valued. And according to the 5-year average for the PE ratio, 12.8, right now about 10.8, is kind of also flat. So that kind of gives us an idea of where the stock might be in terms of valuation right now. Again, it's not accurate, but just to use that for what it is. Free cash flow per share, we're looking at about $14.1. And a couple of more things I want to show you here. Sales, again, up and down. So again, very cyclical business. 1 year is up, next year is down. So that's probably one of the reasons. But when we look at the actual numbers for the sales, as you can see, $212 billion to right now $203 expected for the next 12 months. And as you can see, 2022 was actually their most profitable year in terms of basically sales. That does not generate profit straight away, but of course, you know what I mean in terms of revenue. $236 billion US. And as you can see, they're buying back their own shares. So they're slowly buying it here and there. And again, this company is also in the process of buying another oil company. I think it's called Hess, I can't remember now. But yeah, so both of them are now in the process of buying another company. So we'll see what happens with that sort of a thing. Return on equity about 16%, return on invested capital 15%, and the operating margins of 15%, and free cash flow margin of 10%, which is really solid. Net to EBITDA, again, we're looking for 1.5 and below, and 0.239 is basically for the next 12 months, which is absolutely fine. That means they have enough to cover. Now, in terms of looking at Seeking Alpha, as you can see here, the Seeking Alpha analyst is saying is a buy. Wall Street is a buy. Quant is actually saying is a hold. So let's look at their buy ratings first from Wall Street. And that is 17% upside from where it is right now, $178 US where they think. Now, this is where it gets interesting, because the earnings is basically very similar to what's happening with Exxon, but the difference is next year they're expecting a positive, about 4%, is about 6%, just over 6%, which is quite nice. And then after that, basically it is kind of declining. 204 billion to the next whatever years to basically 172 billion. So again, there's a bit of a decline as well. So this is why I just don't like oil companies, because you can't really predict what might happen. And now next year, like I said, that 6% was there, and then the next 5 years, when they average out all the numbers that we've just seen, is about minus 5%. Now let me just show you one more thing, and that is Morningstar valuation. So 3 stars right now, fairly valued. $172 per share is where they think the price should be. 152 is where it is right now. And don't forget, these companies have a narrow economic moat as well. Now, looking at both companies and putting side by side, comparing their total returns in the last 5 years, as you can see, Chevron has 76%, or let's call it about 77%. total return, and then Exxon has 92%. Now if you move that to the basically last 10 years, Exxon, basically Chevron has done about 86% and Exxon is about 58%. So it's not bad when it comes to the total returns in the last whatever years, despite their cyclicality side of things. So I'm definitely going to do a little bit more research. These are the two that I really like. There's one more I like, actually, EOG, and I might look at that as well, but I will share with you guys. But I thought, you know what, let me just share with the community what I'm currently looking at, because if that sector is down, and this company is actually down quite a bit for the year, okay, if we just look at, for example, if we change this if we change the metric, for example, performance, and just put just a price only, okay, and just a year to date, let's go back, a year to date price, as you can see, they're both down. Whereas the S&P 500, basically we're looking about 20%, 25%, and so on. So what I'm going to do is I'm going to do a little bit more research and see if these companies are actually worth investing in the long run. So if I hold it for the next 5 years and so, what will my return would look like, okay? And are there other opportunities that are better than this moving forward? Anyway, that's what I wanted to share with you guys. I hope you enjoyed this content. If you are, please like, subscribe to the channel. Let me know if you have any questions. Join us on the Discord, join us on the Patreon. That really genuinely helps the channel. So have a wonderful day. Assalamu Alaikum.